Fubo TV sits at the intersection of three major trends right now: streaming TV, connected TV advertising, and sports betting. The stock up significantly since going public via SPAC, but it has pulled back from an all-time high of $62 a share. Bulls, though, still optimistic about robust subscriber growth. We'll talk about that a little bit, but also the accelerated plans for Fubo TV Sportsbook. Not everyone, though, is buying in on the hype, and with us now on Voices of Wall Street is Andrew Friedman. He's communications sector head and partner at Hedgeye, which is an independent investment research firm. Great to have you with us, Andrew.
Yeah, thanks for having me on. I'm excited to be here. Just the big bad Fubo bear.
Yes, it is. Before we get started on the Fubo conversation, I want to just have you clarify what Hedgeye is, and if you have a stake in the game here, if you have a position where you might benefit or not from the position you're taking.
Yeah, so Hedgeye, we're an independent investment research firm. So we pride ourselves on really having no conflicts of interest. We don't have an investment bank. We don't have a broker-dealer. Our subscribers range from institutional investment managers, so hedge funds, large mutual funds, family offices. We also have a pretty large mass market business as well with a bunch of retail customers, which if you just go to hedgeye.com, you can get all the information there. So, I know that there can be a lot of confusion out there because a lot of other firms will put out short reports and it will be used to pump their position that they have. So they may have a short position on a certain company and then put out the report and hope that the stock price goes down in order to kind of manipulate that stock price. I think that's unfortunately what a lot of investors and retail investors have come to learn as being kind of par for the course when it comes to short selling. That is not what we do. Okay, I want to make that very clear. We're an independent research firm. We make our money off of subscriptions, right? Whether it's institution or retail. And our clients, we have very strict policies in place where our clients do not know when we're going to come out with on an investment recommendation, whether long or short on a company in advance. So that is hopefully that clarifies a couple things in advance. Nobody knew before we're going to put that short report out in Fubo, other than my analyst who works with me, that it was going to happen. So hopefully that helps.
Yeah, I think it's important because we do have a lot of people who are excited about this new company coming to market and that they want to look at their future projections of growth. And, this is a conversation which looks at that as well, but from a lens that you're seeing some concern. So let's start there. What have been your biggest concerns with Fubo TV's future?
Yeah, there's a pretty long list of concerns. I think to maybe level set this conversation, the biggest issue just comes down to what do you believe is the future of sports consumption when it comes to either streaming or any type of distribution. Where's that content going? And it can be taken back to the same debate of Netflix back in 2012, 2013. What was going to be the future then? Was it going to be SVOD and Netflix, or was it going to be your pay TV subscription through your Comcast or your Charters of the world? And then the question then becomes, well, where is the content going, right? So what we've seen in the world of scripted content, and that's like scripted Stranger Things, the likes of that, is all the best content is being made for these streaming services. Disney Plus, Hulu, Netflix, The Mandalorian's going on Disney Plus. It's not getting distributed through ABC, right? And sports has lagged, right? And there's a lot of reasons for that. A huge reason for it is just the duration of sports rights contracts. They can be anywhere from 5 to 10, sometimes even 10 years, sometimes longer. And so we're in a really fascinating time right at this moment where all these rights contracts are coming up for renewal. And at the same time, all these big media companies have their streaming services in market, in place. And for somebody like a Fubo, the question you have to ask is 5, 7, 10 years from now, do I think that I'm going to be watching the NFL, right, on CBS through my pay TV provider or through a Fubo TV, or am I going to be watching the NFL through Amazon, through ESPN Plus, through my Disney Plus and Hulu bundle, right? And I think for me, that's like the overarching theme. And there's a lot of other reasons we can go into detail. But from a top-down perspective, I fundamentally believe that sports rights and distribution is shifting to these owned properties, which is going to go away from the Fubo TVs of the world.
Let's talk more about that just top level view. And you mentioned Amazon as an example of an owned property. There's also, I'm thinking, is YouTube TV part of this? Is Hulu? I mean, the sports rights also are very expensive, and we know that once secured, right, it seems like you're locked into those contracts for a while. So if you own them, let's say at Amazon, when they really first made news with that, they had that sort of locked down for a couple of years, and then that would make it harder for like a Fubo TV to come in. Is that sort of the right understanding here?
Yeah, I mean, that makes sense. I mean, look, let's think about, we can give you a tangible example, right? 4 years ago, actually, no, not even 3 years ago, if I wanted to watch the Super Bowl, right, as a cord cutter, the only option I had was to subscribe to a Hulu with Live TV, a YouTube TV, or a Fubo TV, what are known as the vMVPDs, right? Fast forward as of last year, right, all of a sudden I can watch the Super Bowl streaming for free through the Fox Sports app. This past year, I was able to watch the Super Bowl through the CBS All Access app, which has since been rebranded as Paramount Plus. Another example is if we look at Amazon Prime, right? Several years ago, they struck a deal with the NFL to have the rights to stream, the exclusive streaming rights, not the exclusive distribution rights, but just for streaming, for Thursday night NFL games. Right, so I could still watch Thursday Night Football through Fubo TV, through my Comcast pay TV subscription, or through Amazon Prime. But what we've seen is that because of the success of streaming and how big of an audience it garners, that now Amazon and the NFL is actually starting to talk about getting exclusive distribution rights to Thursday night NFL games. And what that means is all of a sudden, the only place I can watch my Thursday night NFL is through Amazon Prime. I can't watch it through Fubo. And that comes down to who owns the sports rights, right? And eventually what happens is, just like we saw the value proposition of scripted content on cable get decline over the years, right? Because all the best content is going to these owned properties. The same thing is going to start to happen with these streaming services, because I got to tell you, Bob Chapek and Disney, Bob Chapek is Disney's CEO, and the Walt Disney Company as an entity, they're factoring in ESPN Plus in all their distribution rights negotiations for sports going forward, right? So I think that just becomes the biggest structural headwind for the like of a Fubo, for the likes of a vMVPD in general, and just overall, pay TV. I mean, the bundle is been like the bull case on Roku and Netflix has been the demise of the bundle, right, of pay TV. For somehow the bull case, but then the bull case on Fubo is that the bundle is the future. So it's very it's conflicting, right, narratives in a lot of ways, and it's just not where the world's heading.
When you talk about bundle, is that sort of a good way to translate what a vMVPD sort of stands for? I mean, for those who are not, okay.
Yeah. I mean, I'll just summarize that really quickly, because I know there's a lot of vernacular. So when I say the bundle or pay TV or traditional, I am talking about you get a Comcast subscription, you turn on your TV and you're flipping through the channels and it's linear content. Okay, it's the same thing that Fubo TV is, except the difference is that it's not getting distributed through your cable company. It's getting distributed over the internet through kind of your future digital cable company, Roku, because they have the platform.
All right. Well, I want to talk more about just Fubo before we get back into sort of the future for them and more of the competitive landscape. We have talked to the CEO of Fubo recently here on Voices of Wall Street, and at the time they were talking about this idea of exclusive sports licensing. You mentioned it. If that were to be the case, with an Amazon more or less down the line, that would be kind of a threat. So when you do hear something like that from the Fubo leadership team, do you feel like it's a reasonable expectation that they will eventually be able to get these exclusive licenses?
Maybe for something like cornhole. I know I'm being kind of flippant in that comment, but the reality is that these are multi-billion, the top why someone subscribes to a Fubo TV, right, is because they want to watch sports content, right? Or that's the only reason why anyone subscribes to a live TV service is because they want to watch sports. If we look at the lineup of sports content that Fubo TV has compared to their competitors, it's actually, they don't have really that much more sports content than others. In fact, there's some really big holes in their service. Like, for example, you can't watch March Madness on Fubo TV, right? That's the second most watched sporting event in the U.S. is not available on what is being branded as the number one sports focused vMVPD service out there, right? So that in and of itself is a little bit of an issue. And when it comes to exclusivity, there's no way that Fubo is going to be able to go out and spend billions of dollars to acquire sports rights for any of this. Now, could they go out and strike a deal with Warner to get access to the Turner, TBS, TNT, and the Turner nets so they can all of a sudden have March Madness? Sure, they can do that, but it's not going to be exclusive, and it's going to be very expensive for them to do so.
Well, one thing that they talk about is we're Fubo, you come for the sports and you stay for the entertainment, right? I'm sure you've heard that.
Yep.
that from them before, and you just laid out the case for how expensive that might be. But if we talk more about sort of the original content side of their plan, do they have enough to be able to spend on the entertainment side, or is it also a matter of then acquiring that content?
So if we look at the business model for any type of pay TV distributor, whether it's an MVPD or vMVPD, right? The way that this works is that, Hope, you subscribe for $65 a month, okay? And you get access to 65 channels. I'm just making up numbers. And those 65 channels are owned by 3 to 5 a conglomerate of media companies, and there's a cost per subscriber cost for each one of those channels, right? So maybe for ESPN, that cost per subscriber is $3. Maybe for Discovery, it's $2. Maybe for AMC to watch The Walking Dead, it's $5. I'm making up numbers here, but that's basically the gist of it, right? When you add all those costs up for those 65 channels for Fubo, it equates to, if not equal to, or more than your total cost of the subscription for $65, right? So therefore, the core business is structurally unprofitable, and those per subscriber costs are growing between 5 to 10% a year. So I don't think that the whole come for the sports, stay for the entertainment, maybe it's a nice slogan, but in reality, it doesn't have any business model implications. The fact is that they position themselves as a sports first service, but maybe about 15 to 20% of their total consumption hours is actually on sports. The rest is for entertainment. And I'll ask you a question, and I'll ask everyone who's listening to this podcast the same question. Do you watch general entertainment on live TV, or are you watching Netflix, Hulu, Amazon Prime, Disney Plus? I mean, and that's the question. So it's a very small segment of the market that is focused on consuming content on linear. That's not the future, right? The future is with all these other services. So I don't think that their content strategy is unique. It's a commodity business. There's no leverage in the business model. And there's no exclusive content that they can really get that's going to allow them to provide any type of scale benefit or a significant churn benefit.
But what about the betting aspect? I mean, they have this new
sports betting.
Yeah, so let's talk about that, because I know people are very excited about a future where Fubo TV Sportsbook could be expected later in the year, and we know the leadership team has been excited about that. Some people have exclusively or have talked about the Fubo, as a blend of sort of maybe Roku and DraftKings.
Boy. Yeah.
So let's get more of your take on whether or not you believe that is the right way to look at what this new product might be for them.
So because the core business is structurally unprofitable, right? And they lose a ton of money. So they, for every $65 subscription they make, they lose about $120, right? So those economics don't work. So what do you have to do? You have to find your next act, right? In order to sustain growth that's potentially more profitable. So it is, and we've seen other platform companies do this, right? So Roku, for example, is very successful in being able to take their core hardware business, their core platform, and their operating system, and then leverage that through a broader advertising model and also distribution model for subscription services that was much higher margin, right? Which is the bull case on Roku. Now, Roku is a platform, right? They are the app store. Okay, so I want to be very clear because people compare Fubo to Roku all the time. This is as simply as it's more complicated than this, but as simply as I can put it, Roku is the app store for streaming. Okay, Fubo is an app within the app store, right? So one has scale, one has economies of scale, one has leverage, one's a much higher margin business. The other one doesn't. So I can create an app, doesn't mean that it's going to get to scale. So I just wanted to make that point, pretty clear. And then in terms of sports betting, it's look, it is going to be incredibly expensive for them to scale any type of sports book. They're going to be launching a free-to-play game in the summer, right? It's going to, and I cover Zynga and I look at all these other smaller gaming companies. It's not a big business. Maybe it helps with engagement on the margin, but in order to actually put something in market that is going to be incredibly differentiated, that's going to attract people to go from DraftKings or FanDuel to Fubo TV, they're going to have to spend a lot of money in what's known as subscriber acquisition, which is basically selling and marketing costs. On top of it, they're going to have to offer a lot of credits. So the other thing that people don't understand in sports betting is that there's the gross revenue and then there's net revenue. The gross revenue is the total value of the sports bet. The net is when you subtract all the credits. So if you go to if you go to DraftKings, they'll say, hey, we'll give you like a $300, $400 credit, right, to go gamble or to bet on this game. That means that a lot of these sports companies or a lot of these gaming companies can actually have negative revenue when they first launch, on top of hundreds of millions of dollars in subscriber acquisition costs, and which is, like I said, selling and marketing. So it could be upwards of $200, $300, $400 to acquire a subscriber in sports betting. So when I look at the fact that this is a company that is burning $100 million ish a quarter in operating losses, and that they have $350 million of cash or so on the balance sheet post this last convertible raise, then we're going to get to the end of the year, and they're going to we're going to get to the end of the year. They're going to have to do another capital raise to keep the core business running for another 12 months. And then they're probably going to have to raise another $300-400 million if they have any chance of being successful in sports betting. So there's no competitive advantage here with Victory, with both those sports. There's nothing unique. And if you just look at Dish Network, which is, I'm not really bullish on Dish, but if you look at Dish Network, for example, and the deal that they did with DraftKings to integrate sports betting directly into those set-top boxes, I mean, that's just case in point. Like, the barriers to entry are enormous to get scale in sports betting, and Fubo is not going to be able to do so profitably or in a way that's going to really change their business model.
I want to unpack a couple of things that you
said. Sorry,
no, it's great. and I want to start with this idea that the Roku, I think, comparison is very clarifying, I think, for some people who might have been looking at them very similarly. Fubo TV ultimately still is behind a wall. In order to get to Fubo TV, you have to kind of go through another layer, another kind of app store.
They're not a platform.
Right. You kind of have to go seek it out. It hasn't been sort of that default install, right? So that's one barrier that you're saying.
Correct.
Then you have the costs, and when we talked to the CEO here, he had mentioned that, all right, yes, but there are some synergies in those costs. So with marketing, with customer acquisition, I mean, if you're looking at the organization of Fubo TV right now, which department do you think has the most pressure on their shoulders right now to continue the growth? I mean, is it in the partnerships? Is it in the deals that kind of to get to the point? I mean, if you were to take a bullish position, right, and you were going to say, all right, well, granted there aren't all of these uphill battles, but there are still some opportunities for them to make some headway. Where would that fall within the company?
Yeah, so I think I pride myself on understanding the other side of the trade and not just being this blind bear. Look, there's two paths for Fubo to scale and win. Even though I think it's low probability. It's a game of survival, right? So you have Google with YouTube TV, you have Hulu with Live TV, you have Fubo TV, you have a whole host of other smaller players in the space. And so the way that Fubo TV can win, and what we've seen this happen in occasions before, is that Fubo is a singular focus company, right? They will live or die by the success of this business. For Google and YouTube TV, for Disney and Hulu with Live TV, they're larger companies. For Google, if YouTube TV went away tomorrow, not that big of a deal, right? They can make that decision. It's not going to have a huge impact on their business model. So the incentives aren't as aligned. So what could happen is if Fubo TV continue, because it's right now what Fubo is doing is borderline irrational from an economic standpoint because the subscriber acquisition costs are so enormous. But the street, because of the market environment we're in, continues to give them access to capital. So in theory, if they continue to get access to capital and they can continue to spend more and more aggressively, right, than their peers are willing to do, then it's possible that YouTube TV, Hulu Live TV say, we're out. We're going to exit the market, right? And that could be a mini watershed event that allows Fubo TV to just all of a sudden capture a lot of those other users, okay? The other flip side, the other big potential watershed event could be that the cable companies facing deteriorating unit economics actually decide that they no longer want to be in the pay TV business, right? And therefore, they're going to partner with a vMVPD for that type of distribution. And in that case, a Fubo TV could be the one option. For example, Verizon, for their Fios install base, they partnered with YouTube TV, right, as an option for some of the users. Now, that still doesn't get us solve the long-term top-down issues that I mentioned before, but that is one path to success, right? So they can continue to need to spend aggressively to scale. And in terms of, what business unit within the business is under the most pressure, the entire business is under incredible amounts of pressure. This is a company that has been having to face bankruptcy and insolvency every 3 to 6 months since its founding. I know a lot of people talk about how the media companies are investors in this company, but the reality is that Fubo was trying to get them to take equity in Fubo TV instead of having to pay the full rates for all their carriage agreements with the media companies, right? So they were trying to use their equity as a non-cash currency instead of having to pay them cash, which they didn't have access to. So there are paths for success here. The advertising business continues to scale. That's going to be a really important part as well to grow. But the reality is that if you just look at the business model, which is not unique compared to even a pay TV operator, if I assume they get to 2 to 3 million subscribers, $20 in ARPU, which is advertising revenue per user or average revenue per user, I still can't get this business to be profitable, right? Because they have tremendous amounts of fixed costs just from now being a public company on the operating line. And again, I said before, their cost per user is $125 a month. Their revenue per user is $65 a month, okay? So somehow, in order for them to be profitable, they either have to raise the price to above $125 a month or get the $125 value down. And there's really no compelling path for that to work for them in their favor. Even if they raise price, what we've seen before with these services is that the value proposition of a vMVPD today is that it is a lower cost than cable. That's not sustainable. So as that gap closes, as they raise price, churn goes up, subscriber growth slows, and the business model unfolds.
It sounds like there needs to be several stars aligned for them. Sort of the, the death, if this were Survivor, you'd have to kick some of these competitors out that you mentioned, and then also get the partnerships and get those other costs down while almost raising subscriber costs. So that's a lot of things for them to try to get off the ground. Since you mentioned, DraftKings and Dish earlier, I want to get your take on that deal specifically.
Yeah.
What do you make of it?
Look, I don't think it's that great of a deal. I mean, I think it's interesting. I don't think it's going to be a game changer. I mean, in the game, the name of the game, right, in sports betting today is subscriber acquisition, right? And so, can you lower your subscriber acquisition costs because it's become so high because everyone's going after this market? So, to the extent that a DraftKings can partner with a Dish Network and integrate into their set-top box, which, by the way, Dish Network has over 10 million subscribers, right? So versus Fubo TV, which has 550,000, right? By having that extra integration and that distribution partner with Dish, in theory, allows them to lower their subscriber acquisition costs. And it's the same bull case that is being made for Fubo TV and integrating sports betting into the app over the long run. If it can materially lower their subscriber acquisition costs, if they have if their core base is just more naturally inclined to bet on sports to begin with. The issue is that Fubo needs to get to 4, 5, 6, 7 million subscribers, right? Like tomorrow. They have 550,000 today. And I think it's going to be very hard for them to continue to grow and scale their subscriber base. So that's, and also even if we look at peers, like the subscriber acquisition costs when you don't have any like differentiated media or IP, like, so going back to our initial part of the conversation, Penn has Barstool Sports. There was a reason why they did that deal. So, Fubo doesn't really have anything in the way of unique IP that's really going to help with them on the subscriber acquisition front.
I asked you to sort of concede two things, and you shed some light on where you think some of those slim possibilities may come through. What do you think investor appetite is going to be? I mean, we know that for the most part, some of these the companies that say they're going to be growing a lot more quickly and bigger in the future, they kind of get a pass from investors in the near term because they understand lots of these things take a lot of money in order to build and grow. At what point do you think investors are going to say, you know what, we really want to see profitability, we really want to see the path to profitability shrinking? What do you think it's going to take for investors to also...
So trust me, I am no stranger to that reality. And I think the worst short calls in the history of mankind have been not understanding that dynamic, right? So like Tesla, Netflix, having a very loyal, large institutional base that believes in the future of what you're building and is willing to give you access to capital, right? And in the case of Fubo, I don't think it necessarily has. I mean, I think profit and trust me, I understand that profits don't matter in the short term if you believe that there's a path to profitability in the long term, right? The issue with Fubo is that it is not a secret amongst the institutional community of what this business is, right? This isn't some emerging company. Like the institutional community knows how terrible of a business this is. So that's one issue. The other issue is that most people don't think that it will ever be structurally profitable, just given the nature of the content costs that we talked about. And then, everything comes down to price, right? So the way that investors often think about valuation and what something's worth is they say, how many subscribers do I think they can get in the future, right? What's the profitability going to be? And what's my multiple that I'm going to put on that? And in the case of Fubo, at $5 to $10 a share, it's a great story. Like, you take that bet, right? Because you're probably getting fairly compensated for the risks inherent in the core business. And then you have the sports betting option, which may or may not hit. In the case of, at $40 and above, it makes the valuation equation, you're discounting so much of the future success today. And I think that's what a lot of people miss, especially amongst the independent investment community who just look at the business at face value, not realize that, stocks are discounting mechanisms for the future and that a lot of good news can be priced into a stock today. So, you have to convince people that that this is a sustainable business model. I mean, at the end of the day.
One thing I asked your colleague, and I think I'll start to end with this question for each of these interviews is, what does then an ideal Fubo TV look like? One that you feel you could be bullish about.
Let's see. I think those two dynamics would have to manifest that I said before, right? We would have to see a big competitor.
But if you had to revamp it, or to get it to what would a healthy Fubo TV look like? Those things that you mentioned.
It doesn't exist. The BMVBD model is a structurally unprofitable, broken business. The only solution for them to be successful is if they can get to scale, which is going to require some of the larger competitors to exit the market, or for the cable companies to also give up a market and partner with Fubo. And it becomes a scale game, right? But as it stands today, unless if you can get over those two hurdles, the core business is unprofitable. The sports betting component of the bull case is just a call option, and it's going to be, it's in my opinion, cost prohibitive for them to do. So so unless if they can actually manage to get their costs down on a per subscriber basis, which again, you need scale to do that. You need to get to 3, 4, 5, 6 million subscribers in order to go back to the media companies and say, hey, give us a better deal. They're not there today. So I think that's the biggest issue for the company, and that a lot of other dynamics are going to have to take place. It's just a bad business. Like, it's nothing personal against the CEO or anything, or anyone who's long the stock. Like, it can just be a bad, like, some businesses are just terrible businesses. Like, it is what it is.
All right, last question. I know I keep saying that, but
No, it's okay. I'm here all day. No.
Well, I think what you mentioned with respect to YouTube TV and Hulu, I mean, these owned properties, I mean, well, I think Hulu's a different story, right? I think they do have the scale that they need to make these types of conversations and contract negotiations more attractive and in their favor. But, something like a YouTube TV, for example, I mean, so what is the metric for success for these experiments, more or less, in this space, which you fundamentally feel is pretty flawed?
Well, look, I want to be very clear. As a standalone business, it is not sustainable, right? Which is why they're going into sports betting, which is why they're trying to find some other business to go into, right? Because that's the only way that the entire entity can survive. A Hulu with live TV is part of Disney, which, by the way, owns a ton of media networks and it has a bunch of media assets, and a huge advertising division, and it's bundled in, and they have original content with Hulu, right? So that's a completely, and they also have 5 million subscribers and large distribution network. So that's a little bit different. YouTube TV is part of Google, right? Which has, and YouTube as a business unit is massive and growing very quickly. So I want to be very clear in that, like, the core vMVPD business is a bad business on a standalone basis, right? Without anything else, right? But if it's part of a larger strategic play, right, or a part of a larger organization that owns media assets, that has exclusive sports rights that they can leverage in other parts of the business, then it becomes much more interesting. Right? Fubo TV, unfortunately, does not even come close on most of those metrics. So that's kind of the biggest issue, which, we'll see what happens when they launch the sports book, but I don't know if investors are going to really fund those types of losses for that long.
So video on demand, really probably the better bet, which is why we're seeing so much of this original content from the Netflixes of the world. And then, if you look at Paramount Plus, for example, and Peacock, I mean, these are also just,
look, I'm sorry to cut you off, but
no.
If I want to watch March Madness, right? If I want CBS has the rights. I can go subscribe to Paramount Plus. I think like a commercial-free version, $6.99 a month. Or I can get a 30-day free trial. So am I going to do that? And if I'm a cord cutter and I want to watch March Madness, am I going to subscribe to that? Or am I going to try to subscribe to a vMVPD that's going to charge me $65 a month? Right? And that's it. That is like it all, at the end of the day, it just comes down to, where do you think sports and content is going to be distributed going forward? And it's going to be distributed through ESPN Plus, Amazon Prime, Paramount Plus, HBO Max at some point, Peacock, Comcast Peacock with they have a big rights deal with soccer. It's not going to be through linear TV, traditional forms of distribution. And that's where we come to, that's where you end up falling at the end of the day. It's like, and you follow the bouncing ball and the strategic logic, and then it just comes down to, what is your value in terms of IP, and where can you differentiate and where's engagement going? And it's not in Fubo's favor long term.
I think you've made some pretty convincing arguments. We'll see how everyone else feels once we post this video. But it's a great
guy. I really am. I have a dog. I like long walks on the beach. My wife likes me. I like craft beer. So, I'm not this big bad bear, but,
I know these attacks do get personal, so I appreciate you humanizing yourself outside of your analysis. It's a great conversation to have with you on a Friday going into a weekend where we're all going to probably be watching more TV. Andrew, great to chat. We'll see you really, really soon. Andrew Friedman is Communications Sector Head and Partner at Hedgeye. Thanks again.
Thanks, Hope. Take care, guys.